Hello, property navigators. Today, we're diving into an essential topic for all property investors, understanding property market cycles in Australia. Now, whether you're new to property investing or a seasoned pro, this video will enhance your knowledge and help you make informed decisions. Let's get started by looking at the past few years to paint a bit of a picture. Now, we experienced a once-in-a-lifetime boom in 2020 and 2021, driven by falling interest rates amid strong demand. But since, Australia's property markets experienced a downturn in 2022 as interest rates rose. Now, it appears we've hit the bottom with asking prices rising across the country. Now, this is the property market doing what it has always done, moving through cycles, influenced by factors like interest rates, consumer confidence, government policies, and basic supply and demand. So what exactly are property cycles? A simplistic version of the cycle looks something like this. Now, picture a cycle that's set in motion by population growth. This leads to more people needing homes, escalating the demand for real estate. This group includes not just investors hunting for profitable rental opportunities, but also owner-occupiers on the lookout for their dream homes. As this demand surges, it acts as a catalyst, driving up property values, all thanks to the timeless principles of supply and demand. As the market heats up, builders and developers jump into action, embarking on the construction of new dwellings to cater for this burgeoning demand. Yet, in this dance of supply and demand, there's often a tipping point. The market at times tips towards excess and oversupply of properties. This glut can lead to a downturn marked by decreasing property values and reduced rents. Now, there's 4 key phases in a property cycle as shown in the graphic on screen. First, the boom phase, a period of rapid price increases, sometimes over 20% annually. Next comes the downturn, where an oversupply from the boom leads to reduced values and rents. Then the stabilisation phase, where the market evens out, offering great opportunities. And finally, the upturn phase, where values and rents start rising again. Let's address a common question first. How long do property cycles last? Now, the truth is there is no set duration for these cycles. Historical trends reveal that peaks in the property market typically occur every 7 to 9 years. But it's important to understand that these cycles are not just dictated by the passing of time. They are intricately influenced by a variety of factors, including economic conditions, societal changes, and government policies. Take the recent boom, for instance. It was extended by a period of falling interest rates, making borrowing more attractive and fueling the market. Now, let's take a closer look at each of these cycles. First up, the boom phase. This phase is usually the shortest in the cycle, but it's marked by rapid and significant increases in real estate prices, often soaring by more than 20% each year. It's a time when new investors flock to the market, driven by the allure of quick gains. At some time, would-be homeowners also contribute to the rising demand for houses. The result? A surge in property prices. Builders and developers don't miss this opportunity. They rush in to launch new projects to capitalise on this growing demand. But what goes up must come down. Following the boom is the downturn or slump phase. This phase is often characterised by an oversupply of properties. Remember the builders and developers who rushed in during the boom? Well, their over-enthusiasm typically leads to this oversupply. Consequently, we see increased vacancy rates and declining rental prices. In this phase, the growth of property prices halts, and sometimes values may drop by around 10%. The duration of the downturn can vary, but after prolonged booms, this phase can be longer and more severe, with a higher likelihood of further price falls. Next, we enter the stabilisation phase. This is where the market starts to recover, aided by falling interest rates and a build-up of demand that wasn't met during the downturn. However, this isn't a phase of rapid price escalation. It's more a period of adjustment, where the number of buyers and sellers reaches a bit of a balance. Property prices stabilise, perhaps rising slightly. For keen-eyed investors, this phase offers incredible opportunities, though they're not often obvious to many. Finally, we come to the upturn phase. This is when things start to look really good again. Vacancy rates gradually decrease and rents begin to rise, and property values start their upward trajectory once more. During this phase, which can last 3 to 4 years, property remains generally affordable, and the returns from property investments can be quite attractive. This draws more and more home buyers and investors back into the market. It's also a time when builders and developers start all their projects again, aiming to complete them in time for the next boom phase. As this phase concludes, property prices will have increased quite significantly, making real estate less affordable for many Australians. And then we start all over again. But how long do property cycles usually last? Well, let's unravel this mystery with some data-driven insights. Property cycles don't adhere to a fixed duration. Let's get that out of the way first. They're as varied as Australia's landscape itself. But if we look back at the trends from recent decades, we can identify peaks in property growth in 1981, 1987, 1994, 2003, 2010, 2017, and most recently, 2022. It's no wonder why some people believe these cycles span about 7 years. Delving deeper, the stats reveal something even more intriguing. Over the past 40 years, well-located properties in capital cities have seen their values double roughly every decade. That's an average growth rate of about 7% per year, according to the Real Estate Institute of Australia. But property cycles are dynamic. There are times when values soar and other times when they plateau and even just dip for a bit. The duration of each cycle is influenced by a medley of factors: the state of the economy, social and political climates, and even government policies. Even the Reserve Bank of Australia plays a role, adjusting interest rates and influencing borrowing and spending. Take, for example, the most recent property boom, which wrapped up about early 2022. It was extended by a prolonged period of falling interest rates, but eventually concluded as affordability issues emerged, exacerbated by a series of interest rate hikes. To visualise this, let's look at a graph showing house price trends over 2 property cycles. It's a fascinating representation of the ebb and flow of the property market. Understanding the duration and characteristics of property cycles is crucial for any investor or home buyer. It helps you strategize, plan, and make informed decisions in a market that's always on the move. Now, while it's common to speak of the property market as a single entity, it's important to remember that Australia has a tapestry of diverse submarkets. Now, each state in Australia experiences its own property cycle. Even within each state, the markets are further divided by factors like geography, price points, and property types. Every local government area and every suburb is effectively in its very own market. Now, this means that the high-end and top-tier market behaves differently from the market for new home buyers, which is distinct again from the investor segment or the established property sector. During the last property boom, we witnessed almost every property in Australia increasing in value. However, the current scenario is quite different. Each state is now charting its own course, influenced by economic conditions and the balance of supply and demand. But what else should you know about property cycles? Well, our property markets and the fluctuations within them are largely driven by 2 powerful emotions. We have fear and we have greed. This was especially evident during the last boom when rising property values triggered a widespread case of FOMO, the fear of missing out. Ironically, FOMO is a form of greed. Over the past year, as interest rates have continuously risen, fear has taken the driver's seat. Many home buyers and investors have been hesitant, waiting on the sidelines for more certainty. It's also worth noting that Australian property markets often overshoot. This means they react more dramatically than changes in fundamental influences might suggest, both on the upside and the downside. These swings in the market are driven by fear and greed, and they're amplified by crowd psychology. This psychology can significantly influence people's home buying decisions, sometimes to their detriment. Investors and home buyers are often most optimistic near the peak of a property cycle, exactly when they actually should be more cautious. Conversely, they're more pessimistic near the bottom of a cycle amid widespread doom and gloom, when in fact, the risk might be at the lowest. Now, during the boom phase, the fear of missing out on potential profits can lead to hasty buying decisions. On the flip side, during the slump phase, there's a prevalence for buyers to have fear of buying early. Many home buyers and investors hold back, worried they might buy only to find cheaper options soon after. But you should never try to time the bottom of the market. Understanding these emotional drivers and their impact on the property cycle is crucial for making informed, rational decisions in the property market. Before we wrap up our discussion today, let's emphasise an important aspect of property investing. Each boom naturally leads to the next downturn, and every single downturn eventually sets a stage for an upswing. It's a rhythmic dance of the property market, each phase leading seamlessly into the next. But here's a key takeaway. While downturns and upturns are integral parts of the property value journey, they are only temporary fluctuations. The overarching trend in our capital cities has been a steady and more prominent escalation in property values. This long-term growth is what ultimately matters for property investors. To truly grasp this concept, let's take a look at CoreLogic's 30 years of historical property data. It's a fascinating timeline that illustrates the ebb and flow of the property market. Now, over the past 3 decades, you can clearly observe 6 distinct cycles. Yet despite these cycles, the overall trajectory has been one of growth and resilience. This opens up a whole new topic on why we buy and hold properties throughout numerous cycles, so you should definitely check this video out here. And apart from that, thank you so much for watching these videos. The community support has been mind-blowing, and we love creating this content for you. Until next time, happy property navigating.